Hello and welcome to AI Market News by LM. Are we looking at a genuine economic boom, or are we just riding the crest of a massive tech bubble? S&P 500 hits new record. Tech bubble? That is our main topic for today's explainer. We're currently witnessing this absolutely baffling paradox unfolding right before our eyes in the financial markets. And wow, is it a fascinating one to break down. We've got the S&P 500 hitting all-time record highs, riding this incredible wave of tech momentum, while at the exact same time, inflation is soaring and macroeconomic indicators are flashing some pretty bright red warning signs.
So let's dive right in. Why are stocks at record highs while inflation just continues to surge? How can U.S. equities be so absolutely euphoric when the critical macro data tells a much more concerning story? It's a massive disconnect that has analysts and investors globally scratching their heads. We're seeing this incredible resilience in stock prices, kind of just completely brushing off the reality of rising costs and climbing interest rates. Today, we're going to look really closely at the data driving both sides of this equation so we can understand exactly what is fueling this market and, more importantly, where the hidden risks might lie.
Section 1. Macro Heat. Let's take a look at the inflation and rate surge.
Based on the prepared resources, the data is just undeniable. The April U.S. Producer Price Index, or PPI, just came in at a staggering 6.0% year-over-year. That is the biggest jump we've seen since 2022. This number significantly exceeded all economist expectations. And a massive driver of this 6% surge, well, it's the spike in energy costs, which is directly linked to the ongoing war in Iran. Energy prices alone jumped 7.8% in April, and that was following a 10.1% increase in March. This is aggressively pushing up transportation and production costs across the board.
And this really illustrates that the problem isn't just isolated to energy. When we strip out volatile food and energy, the core PPI still surged to 5.2% year-over-year. This demonstrates that these intense price pressures at the wholesale level are aggressively spilling over into broader goods and services. Businesses are facing significantly higher costs right now, and historically, those costs eventually get passed right down to the consumer, which just keeps the broader inflation fires burning.
Now, what's really fascinating is how the bond market is reacting to all this heat. The bond vigilantes are definitely waking up. Just look at these U.S. Treasury yields. We've got the 2-year sitting at 3.98% and the 10-year at 4.48%. But the absolutely crucial point here is the 30-year yield, which just crossed that major 5% threshold, sitting at 5.04%. We literally haven't seen the U.S. Treasury Department have to promise yields of more than 5% to get traders to lock into a 30-year bond auction since 2007. The bond market is broadly and very clearly signaling a much more bearish inflationary reality.
Adding another massive layer to this whole macroeconomic picture, Kevin Warsh has just been confirmed by the Senate as the new Federal Reserve Chair, taking over from Jerome Powell. And let's be honest, he is inheriting an incredibly difficult environment. With inflation re-accelerating to levels we haven't seen in years, the market consensus is rapidly shifting. We are officially entering a higher for longer rate environment where immediate interest rate cuts seem highly unlikely. In fact, some in the market are even whispering about the possibility of rate hikes if this inflation data doesn't cool down soon.
Section 2. The Equity Paradox. Time for us to unpack this tech boom.
The crucial point regarding market breadth is striking. We're looking at S&P 500 winners versus losers, with 165 higher versus 336 lower. While the S&P 500 index is hitting record highs, the actual participation of stocks within the index is incredibly narrow. On the very day the index hit its record, only 165 members of the S&P were trading higher, while 336 were actually lower. Think about that. This means just a handful of mega-cap tech stocks are doing all the heavy lifting, driving the index higher, while the vast majority of the broader market is declining under the weight of those high interest rates we just discussed.
So what's driving those few mega-cap winners? It's the absolute euphoria surrounding the artificial intelligence boom. This enthusiasm is so powerful, it's practically overriding all those macroeconomic fears. To put this explosive boom into perspective, some recent data suggests that an AI system like ChatGPT reportedly consumes as much electricity as tens of thousands of US households just to process requests. The demand for processing power is immense, and adding fuel to this fire, according to various news commentary, NVIDIA CEO Jensen Huang is currently in Beijing alongside President Trump for a high-stakes face-to-face summit with Chinese President Xi Jinping. The market is highly optimistic that this could lead to a major breakthrough regarding AI chip accessibility and trade, which is keeping the tech rally fully fueled.
However, as seen in the provided information, we have some serious geopolitical tech risks. This tech rally faces severe geopolitical headwinds that we simply cannot ignore. The AI boom requires massive amounts of energy and very specific materials.
The potential closure of the Hormuz Strait threatens semiconductor supply chains, not just through energy spikes, but by disrupting the flow of crucial raw materials. Furthermore, the complex US and China trade dynamics mean rare earth export controls, and the ongoing security situation in Taiwan remain massive, looming risks over this entire tech-driven market.
Section 3. Global Ripple Effects. Let's take a look at currencies and sentiment. Looking at the currency markets, we can really see the strength of the US economic data and those high yields acting like a giant magnet for capital. The US dollar is showing immense strength right now. The euro to US dollar pair has been pushed down to around 1.1711. And even more striking is the US dollar to Japanese yen pair, pushing dangerously close to 158. This is happening despite clear intervention risks from Japanese authorities. The sheer force of the US macro data is currently overpowering those intervention fears in the FX markets.
To quantify how investors are feeling amidst all of this, we can look at the CNN Fear and Greed Index. This is a tool that gauges the mood of the market using 7 indicators, including momentum, volatility, and safe haven demand. It's a brilliant way to conceptually measure whether markets are currently pricing in macroeconomic fear or tech-driven greed by analyzing distinct indicators, like options trading and demand for safe haven assets.
And this brings us to a truly fascinating data point, 17.79. Despite the inflation spikes, the geopolitical tension, and that super narrow market breadth, the S&P 500 VIX, often called the fear gauge, has actually fallen below 18, sitting right at 17.79. This shows a very surprising lack of volatility. It strongly suggests that, right now, the momentum and greed generated by the AI tech boom are completely overpowering the fear of inflation and higher interest rates. Investors are clearly choosing to ride the tech wave for as long as they can.
Section 4. Looking ahead. Let's check the economic schedule. To prep ourselves for the coming days, let's refer to investing.com for the upcoming economic schedule. We've got a few key events lined up. We really need to pay close attention to US retail inventories to gauge consumer strength in the face of all this inflation. We also have US natural gas storage data coming up, which is critical given the energy constraints we just talked about. Furthermore, we'll hear from key Fed speakers, including Williams and Barr, whose words will be heavily scrutinized for any hints on policy direction under the new chair. And globally, Japan machine tool orders will give us a solid read on industrial demand. These releases, scheduled in US time, could easily shift these dynamic market trends.
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. So, with inflation raging and tech soaring, we have to ask ourselves, are we witnessing a resilient new AI economy, or is this just the calm before the ultimate macroeconomic storm? Thanks for watching. Don't forget to like and subscribe.